We've just had a bloodbath in the UK gilt market. Over the space of 3 months, gilt yields tripled. When the yield goes up, the price of the bonds goes down. So you would have lost money on the gilts in your portfolio. We think that yield rise is going to continue. We also think you should protect yourself by reducing the duration of your bonds. To see what we mean by duration and to see how to check the duration of your portfolio, watch this video. When sailors saw there was a storm at sea, they had to fill the sails. Otherwise, in a storm, the sail could be blown away. The storm that we're seeing at the moment is in the bond market. This is a tweet from the Bank of England today. They compare the dramatic sell-off in UK bonds with previous episodes, such as the US bond massacre of '94, the taper tantrum of 2013, or the Bund tantrum in Germany in 2015. All seem to follow a very similar trajectory in the sell-off. But as they point out in their article, even though the sell-off is very severe, the interest rate or the yield on government bonds at the moment is still very low. This is a snapshot of the UK yield curve today. The government can borrow for different lengths of time, from 1 month to 30 years, and this shows the interest rate it would pay for each term of borrowing. It's less than 0.5% for short-term borrowing and around 2% for 30-year borrowing. Now the drivers of the two ends of the curve are quite different. The Bank of England's Monetary Policy Committee drives the short end of the curve, and that strongly affects the curve around 1 month. If they want to stimulate the economy, the MPC will lower that rate. And if they want to slow down the economy, they raise the rate. And indirectly this affects inflation. The long end of the curve is quite different. It's pushed up by inflation, but also by economic growth. And it's pushed down by fear, an economic recession, or by quantitative easing, which is when the Bank of England buys government bonds. At the moment, we don't see much fear at all. There's very little sign of a recession. Growth has been okay, but we do have QE from the Bank of England. Growth, on the other hand, has been fairly good, and that's pushing the curve up. And so is inflation, which has spiked very sharply recently, and it's still rising. So this is a snapshot. Let's look at the history of the curve for 5-year, 10-year, and 20-year borrowing. What's remarkable is that the rates have been falling for at least the last 20 years, which has been great for bond investors, because as the yield falls, the price of your bonds goes up. What's interesting is that there seems to be a notch. The question is whether this is a turning point. Are we now going to see yields start to rise steadily for a long period of time? Well, let's see what the US Federal Reserve is doing. This is their policy rate since 2008. You can see after the global financial crisis it's been 0, and only in December last year did they start to raise rates. Each of the people around the table contributes 1 dot to each point in the future, and that's how we come up with this dot plot. And you can see they expect a fairly rapid rise in interest rates over the next 2 years. But why should we care? We've got our own central bank and our own economy. Well, this is why we should care, because there seems to be a very strong linkage between our economies. Policy is data dependent. When growth is strong in the US, that often spills over into the rest of the world, and that affects bank policy, but also the yield curve. We have the Fed at the top, the Bank of England in the middle, and the rate in Europe at the bottom. The success of this guy's policies will be extremely important. And yes, they will affect us in the UK. Trump's come up with a private sector funding plan to fuel a $1 trillion infrastructure program over the coming decade. And so have the Democrats. They've got their own $1 trillion infrastructure plan, where they hope to create 15 million jobs over the next decade. If we do compare economic growth in the US, UK and Germany, you can see how the growth is linked between the three economies. The linkage isn't perfect, but we believe that if the US manages to stimulate their growth, some of it at least will spill over into the UK and Germany. The recipe of full employment, which is what they currently have in the US, plus government spending, plus strong job creation, creates a combination of growth and inflation. If you remember the drivers of the long end of the curve, inflation and growth both push up yields. So if we get some growth spillover from the US, combined with the inflation we're seeing, that could push up yields further at the long end of the curve in the UK. And if we do see growth and inflation in the UK, then the MPC will probably push up the short end of the curve as well. So here's the cool bit. This is duration. I've shown here 2 bonds. The one on the left has a lifetime of 2 years. You lend 100, you receive 2 interest payments of 3% per year, and then you get your money back. On the right, we have the same thing, but for 3 years. 3% interest for 3 years, and then you get your money back. But let's say that interest rates suddenly jump up by 1%. Our bonds have frozen in an interest rate of 3%. So if everybody else is getting 4%, we're losing out on 1% per year for 2 years. If we'd lent 100, then we'd lose 2% of that, so our bond would now be worth £98. How about the 3-year bond? Well, there we'd be missing out on 1% for 3 years. So the price of that bond would go down more. It would go down to £97. So you can see that the longer you lock in your fixed interest rate, the greater your interest rate risk. And that's why the duration of the bond is critical. A bond with a longer lifetime has greater interest rate risk because it's locking in the interest rate for a longer period of time. This duration concept isn't just for single bonds. It can be applied to portfolios or even extremely large bond funds. Here are 2 of those funds, both produced by BlackRock. Both of them buy UK government bonds or gilts, but they have one key characteristic which is very different. That's the duration of the fund. You can see that the fund on the left has a duration of 10.77 years. It has a very long duration, so 1% increase in interest rates would push down the value of the fund by 10%. The one on the right has a very short duration, just 2.5 years. So 1% increase in interest rates would only drop the price of the fund by 2.5%. So if you think interest rates are rising, you prefer the fund on the right because it has a shorter duration. Conversely, if you think rates are falling, you choose the fund on the left because you want as much exposure to that interest rate fall as possible. So if, like us, you think rates are rising, then now would be the time to reduce duration and to furl your sails. Here's the legal bit. This is not a recommendation. If you want financial advice tailored to your specific circumstances, seek independent financial advice. Do you agree with us that it's time to cut duration? We'd love to hear your feedback. Tweet us at PensionCraft or message us on Facebook. And if you like these videos, subscribe to our channel.